Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. And in this episode, we're going to talk about mineral rights news for September of 2024. In this episode, we have a bit of a market update on oil and gas prices and what the analysts are saying should be in store for the rest of this year and into 2025. So that is something, if you have oil or gas royalties or both, then definitely pay attention, because some interesting concepts that we're going to talk about, Justin, and I think some interesting takes on this that I think we've been talking about all along, but now the folks are just starting to realize the reality of the situation here.
You said it, Matt. Yeah, and it's not to say that there's not progress in it, but it is going a direction that we've kind of talked about is really the only reasonable stopgap, and we'll kind of dive into that. And Matt, we also have some news on lithium, which has been talked about a lot, and it looks like this one's really about the royalty rates. We had talked about before when they were exploring production that was going to be one of the next conversations, is our landowners being fairly compensated, and sounds like that's exactly the conversation that's being had.
That's a great way to put it. So do you want to dive into that first article here?
Yeah, absolutely. So this first article here, the title of it is Royalty Pains Arkansas Rights Owners Call Lithium Offer Too Low. So 5 big players in South Arkansas, emerging lithium industry, are proposing a royalty rate for mineral rights owners, but they may have to dig just a little deeper. At 1.82% of the market value of battery quality lithium carbonate, the company's number is just too low, according to the South Arkansas Minerals Association. The nonprofit represents landowners in a 4-county region where companies hope to pump up brine to extract the valuable bromine and lithium within. And Matt, instead of the proposed rate, mineral owners are asking that the royalty rate for lithium be set at 12.5% for sales of the lithium carbonate. And this kind of falls in line with, we were talking before we hit record, are we going to go with the mining way of doing this, or are we going to go with the oil and gas way of doing this? And I think that's really what's being talked about now. A quote here from the article says, Arkansas produced lithium can't be sold lawfully until the state establishes a royalty rate, making royalty proclamation the next step for the nascent South Arkansas lithium industry, which faces questions about its long-term commercial viability and scalability. And so, Matt, there's two sides of this coin. There's the, can we pay royalty owners this rate and still make money? And it makes sense. And then the other side with the mineral owners who want to be fairly compensated. And to them, this has a lot of similarity as oil and gas extraction.
Yeah, it has a lot of similarity. It's the same technology that's being used. And the 5 companies in question here in this article that are applying for the royalty rate, it's Standard Lithium's subsidiary SWA Lithium, Albemarle Corp, Tetra Technologies, and Saltworks LLC, which is a subsidiary of ExxonMobil. So some pretty deep pockets here, and they have a lot of experience in dealing with these types of regulatory issues. It was really interesting in reading this article, Justin, that the South Arkansas Minerals Association and the folks that were quoted there have an exploration and production background. So they own drilling companies and they handle timber management. So, they're very familiar with operations and profitability of drilling wells and all of that. So the fact that they were saying that it's too low, in my mind, says a lot. They were doing some back of the envelope calculations, some of the numbers that were submitted originally back when lithium was around $30,000 per metric ton. I think they had quoted some profitability for Standard Lithium was around 31 to 33% with no royalty rate factored in. And then this representative from the association said, well, if you factor in a 12.5% royalty, that reduces the internal rate of return down to 27 to 28%, which is still fantastic. They threw out some numbers to put it in comparison. They said in the mining industry, 14% is the internal rate of return. And they said in my own industry, and happily oil and gas production, we average 4.5% internal rate of return, which I don't know that I agree with that. Maybe for certain types of wells, but I think for the development work that they're doing now, they have a much higher rate of return than 4.5%. I think it's probably closer, probably somewhere in between the 14.5% and the 31%. So at the end of the day, in my mind, that 12.5% royalty certainly seems to be more reasonable given the mode of extraction. With hard rock mining, a lot of times it's a dollar per ton type of a situation or dollar per acre. Like the royalty rate for bromine is $60 per acre per year, which we were talking before we hit record. If you had 100 net mineral acres, you're only getting $6,000 per year. And certainly the companies that are selling the bromine are getting way more than that. So that seems like to way undervalue the value. And so in my mind, I think having something close to that 12.5% makes sense. And, it's hard to put this in perspective, Justin, because we don't really know, what the concentrations are. To your point, we were talking earlier, what is the amount of lithium they're going to produce? How expensive is it to process? In my mind, it's a very similar situation to like natural gas, where you have to send it to a gas plant. There has to be compression and marketing and all the things that get deducted, a lot of times passed on to mineral and royalty owners. So it'd be interesting if the mineral owners in Arkansas are able to get the higher royalty rate. Will the operators try to pass on some of the expenses then to those mineral owners in exchange for that higher royalty rate? So I think it'll be interesting to see with interpretations of these lithium leases. Are they going to try to pass on the proportional share of the cost of extracting and processing the lithium to the mineral and royalty owners? I think that would probably be the next step. They probably will say, well, okay, we'll give you 12.5%, but it's really not going to be 12.5% because we're going to pass along the cost for that. So that in my mind, I'd be very careful if I were, in this lithium owner group, certainly be pushing to negotiate leases that are friendly to the royalty owner from the standpoint of post-production costs, because that could eat your lunch, I think, in this situation.
Yeah, absolutely, Matt. And, there were some test wells in Arkansas that they were in a status where the information or results was classified. But it'll be interesting to see once that time period expires, kind of what the results were from those tests. I'm sure that's part of what is being considered in this conversation.
Yeah, that's a great point. And I think, we've heard of, multiple percentages of concentration. I think on the high end, probably up to like 3%. So if you had just a hypothetical scenario, I think that'd be helpful to put this in perspective. And I think that's what they are asking for. The commission is asking for some of these profitability numbers. And I think if the oil and gas companies can say, okay, here's the amount of water that we produce in these wells, here's the concentration, here are the actual projected number of metric tons, and then by virtue of that, the value per month or whatever, and then they can sort of calibrate that royalty in my mind based on what an equivalent like oil or gas well for somebody that has maybe on a 1 net acre basis, how much is that worth from an oil and gas perspective? And in my mind, the lithium royalty ought to be in line with that. We did some back of the envelope calculations here, and with the density of the lithium carbonate, if you factor that in terms of that density, it is around a third of a metric ton per barrel. It depends on the concentration, of course, but this is just the density in different units. So the density of lithium carbonate is around, again, 1/3 of a metric ton per barrel of lithium carbonate. So, again, if we know the volume of water and the concentration, then you could calculate the number of metric tons and then figure out from there, based on the 1.85% versus the 12.5% royalty, and then figure out what that would actually equate to in terms of a royalty payment. So I think that would be helpful to do to sort of calibrate that. But hopefully they were able to come to a resolution so that this industry can move forward. Because like you mentioned at the beginning, it's really the requirement that they do this before they can start drilling. So.
Yep. You said about, and there'll be a lot of lobbying on both sides, I'm sure, and it'll be interesting to see how that kind of shakes out. So our next story here, Matt, is about oil demand. And there's been quite a few stories that have been going around about this. The one that we're going to start with here is from oilprice.com. It says Goldman Sachs cuts expected oil price range by $5. The article goes on to cite that weaker Chinese demand, higher inventories, and rising U.S. shale production are leading to downward revisions in oil price forecast. Goldman Sachs predicts Brent crude prices to average below $80 per barrel next year, with the possibility of a steeper decline depending on OPEC's actions and a potential recession. Morgan Stanley also lowered its forecast, anticipating a market shift from tightness to potential surplus by 2025 due to increased supply from OPEC and non-OPEC producers. And the article kind of goes on here. It says that Goldman's forecast for Brent to average $77 a barrel in 2025. Brent prices are usually higher than West Texas Intermediate. For example, today WTI is $4 below Brent. So if the differential stays the same, that would mean that West Texas Intermediate prices would average around $74 a barrel next year. And Morgan Stanley has cut their forecast as well for the fourth quarter to 80 per barrel, down from 85, and now expects prices to gradually decline to 75 per barrel by the end of 2025, slightly lower than their previous estimate of $76 a barrel. And Matt, there's some interesting perspectives kind of coming out with this. There's several different ways it's being looked at. Some concern that some of the green initiatives that are being talked about might drive these prices lower, might not have the results that are expected. So it's a complicated thing, and it'll be interesting to see how it turns out. But it sounds like everyone agrees there's going to be some downward pressure on price.
Yeah, and I think I saw another article this morning that the Chinese National Oil Company also predicted that oil prices would average around $75 per barrel in 2025. So I think that's sort of the consensus that we're seeing. Between 75 and 85, I think, is what they were saying, actually. So, and that's Brent prices. So again, when you think about what we're actually paid royalties on, it's closer to WTI, or actually differential to WTI. In other words, a lower price than WTI. So these prices that they're talking about represent Brent prices, which is sort of the international standard. And again, in the US, we have West Texas Intermediate, which generally trades about $4 less than Brent. So if you are getting paid royalties locally in your basin, and it's actually maybe a couple dollars less than WTI, you need to subtract that from these forecasted prices. So if Brent is $75 a barrel and WTI is really going to be 71, and you get paid $1 less than WTI, well, that means your royalty checks would see around $70 per barrel when Brent is averaging 75. So that's something to keep in mind. And, I guess it makes sense, Justin, that we have rumblings of recession. We have the Fed actually talking about cutting rates later this year in 2024. So in my mind, if they weren't worried about liquidity and worried about a slowing economy, they wouldn't be doing that. So that makes total sense to me that we would see a slowdown. And when there's economic slowdown, that means less demand for crude oil and refined products. So I think that certainly is something I could see happening.
Yeah, you said it, Matt. Our next story here is on the other side of this coin. We're just talking about natural gas. And this is where really the highlight on two different sides of a table here where, demand that's being forecasted, there's some questions whether that is really accurate. And there's been an increase in demand growth more so than what was being expected. In this article, which is Net Zero Scenarios Underestimate Energy Demand Growth, the Gas Union says the various decarbonization pathways and scenarios are likely underestimating the rate at which global energy consumption is rising, which could create a supply shortfall of natural gas by the end of the decade. Switzerland-based industry organization International Gas Unit said in its Global Gas Report 2024 on Tuesday. Matt, the article kind of goes on to say that the global natural gas demand continues to grow as it did for the last 4 years without additional production and development. A 22% global supply shortfall is expected by 2030, IGU said in an annual report. And this makes sense. There's some talk about whether some of these decarbonization scenarios, meaning, green projects, what the results of those are really going to be and how much energy can be produced. Versus the rise in energy consumption from data centers and cooling. So it's something that they're looking at. And, there's some concern that maybe we're not properly forecasting the amount of growth.
Yeah, it's really an interesting dichotomy because we just talked about oil prices, slowing economy. You would think the same thing would apply to gas, but there's very different market dynamics in play with gas. Like Justin mentioned, you have the power grid and data centers. And we've talked about AI and the boom in AI, and they're talking about the demand for power from AI data centers is going to double or triple over the next several years. And so from that standpoint, it makes sense. Even with a slowing economy, which oftentimes you have less fuels for transportation, which is primarily from crude oil. So you have things like diesel fuel and gasoline, that those may have reduced demand, but we are still, everybody wants more electricity for various reasons, whether you're in a developing country and they're just trying to get electricity for the first time to replace burning wood and things like that, to in the developed world, we have these AI data centers, and AI is growing exponentially. The demand for that is increasing despite potential economic slowdowns. We're still seeing certain areas that are really focused on that. And I guess it's not that surprising. The International Gas Union, they're probably trying to pump their own bag, so to speak, and trying to say, we need more gas. We're with the gas people. We're here to help. And so certainly, I guess that could be a little bit of a conflict of interest. But it's interesting that they're looking at the transition scenarios, and even like we've talked about when we did a deep dive on that it always underestimates the demand for reliable energy. And so when you have more solar and wind, you still have to build natural gas fired power plants as the backup to those, so that when the wind isn't blowing or the sun isn't shining, that you could ramp up those natural gas fired power plants to meet demand. And so that's the really interesting dynamic here is when we talk about we're increasing the amount of renewables we're installing. Well, you still have to have the equivalent amount of generally natural gas fired power plants to back up those renewables. So by virtue of that, it means you're going to have increased natural gas demand the more wind and solar you put in as well. So lots of interesting dynamics here, but I think it's bullish for natural gas royalties. So if you own natural gas royalties, it means that we should see higher prices. And we've talked about this with respect to NGL exports here in the United States, and that's going to drive demand starting in 2025 when there's all these new plants that are going to come online. And so that should mean that we'll see increased demand for gas here in the US, which should boost prices. And then this globally, certainly is a good sign if you have natural gas royalties, because I think we'll continue to see demand for gas for power generation and for a way to help bridge the gap between where we are today, maybe with coal and things like that, to eventually lower carbon sources like nuclear. So an interesting story, Justin, kind of tale of two cities here with oil versus gas.
Yeah, you said it, Matt. And I think you really said a key point there in that, this is kind of our pathway towards low carbon energy forms. And though it's not being talked about a lot, it is one of the cleanest sources that we can utilize on the path forward. So maybe that's being downplayed a bit.
Yeah, that's a great point. Well, let's transition over to the rig count. Everybody's always interested. What are we looking at? And it's actually down one rig. We're at 566 land rigs compared to a week ago. Compared to a year ago, that was 613. So we're definitely down, about 10% still from about a year ago. It seems to be pretty well stabilized though, Justin. I think we're just seeing rigs go up or down one or two per week. And so, not a big surprise there. We see a little bit of a drop in the gas rig count, flat as far as oil goes. And major state that saw differences, we saw New Mexico drop one rig, North Dakota drop two rigs, Utah drop one rig, and that's all primarily oil focused there. We saw an addition in Texas and an addition in Louisiana and Oklahoma. So, just a couple of rigs here or there that seem to be moving around. I think the Texas and the New Mexico, that's probably just, a rig going across the border. That's all Permian focused. We have the Permian Basin with the highest rig count at 306 rigs operating. Next is the Eagle Ford, which is 47. And then you have the Williston, which is in North Dakota and parts of Montana at 34. And then you have the gas plays still going strong, despite the lower gas prices right now, the Haynesville and the Marcellus. Haynesville is 33 rigs, Marcellus is 25. And again, like we've talked about before, I think we see companies drilling wells but not completing them right now. They're waiting for next year when prices are better, when they turn those on and start selling the gas. And so if you have minerals in those two areas, don't be surprised to see a significant period of time between when they drill a well and when they complete it based on where the prices are today. Because even today, gas prices are still hovering around $2 per MCF, so still pretty low. So
you said it, yeah, and it tells an interesting story. Looking at the numbers, Texas, for instance, is down 33 rigs from a year ago. There was this huge jump that we saw in the rigs being taken down, and it's starting to seem like this is evening out a bit, which is good to see. It'll be really interesting to see over 2025 if we start to see far less change year over year because the production is slow and consistent rather than a big boom and bust.
Yeah, that's a good point. And I think there's a lot of efficiencies that operators have been able to tap into that maybe they didn't need as many rigs as they did before because they're drilling wells faster and things like that. So they can kind of maintain production or even grow it in the Permian like we're seeing. So yeah, it'd be interesting to see what happens. I think, again, unless there's a huge price change in terms of oil and gas, probably this is the status quo for the foreseeable future. If gas prices were to recover significantly, I think you would see a little bit of a bump up in the gas-focused rigs. But for now, I think they're pretty content to kind of wait and see what prices are going to do. Hopefully they go up like we've all been talking about for the past year and a half or so, and I think they will.
It'd be interesting to see, Matt. Well, that wraps it up for this month's news episode, and I'm sure we'll have more to bring to the table next month. It'd be interesting to see how this lithium thing shakes out. It seems to be popping up in the news pretty regularly now.
Yeah, and hopefully by next time we should have an update on that. And we'll really be rooting for the mineral and royalty owners in Arkansas. And, if you're in that boat, definitely push for as high of a royalty as you can get so we can set that precedent and go from there. So, all right. Well, thanks again for listening. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.